Another kind of internal control that we have is a bank reconciliation. It's a good internal control because it allows us to have someone from outside the organization submit a document to us that we can use to verify internal documents. It also allows us to have good separation of duties. You can have a person in charge of the bank rec who hasn't been in charge of entering any accounting into the cash account or have access to cash in any way. Prepare the bank rec. Their only interest is getting the bank rec done and getting it to balance. So another good internal control is to prepare bank reconciliations. Besides that, you need to prepare bank reconciliations to make sure that your checking account doesn't have errors in it. How do you do a bank reconciliation? Well, the format I like to use is say, let's compare what the bank has to what the book has. You take the bank statement and it has an ending balance on it. List that. And then take your general ledger cash account, the ending balance, and list that. And in all the years I've done accounting, and there's a pile of them anymore, those two numbers never agree. Usually it's caused by timing differences and things that the bank has that we don't know about. Let's start from the bank side. What I like to do is take the bank's ending balance and then look at what the bank has added in and compare it to what the book has added in. If the book has added in something that the bank hasn't, then I add it to the bank, and then the two agree. These are usually deposits made on the last day of the month. They're deposits in transit. Deposits in transit. I abbreviated it. So I have the bank dollar amount and the book dollar amount, and I compare what the bank's added in to what the book's added in, and I list differences that the book has the bank doesn't on the bank side. Then I add to the books things the bank has that the book doesn't. Some things might include collections or electronic fund transfers made directly to our checking account. We might have earned some interest revenue. That's another possibility. So the bank might have a deposit they haven't received yet, and they might have collected some things I don't know about. So I need to fix both balances for that. And that takes care of things that were missing that were added in. Now let's look at things that were subtracted out. I look at what the book has and compare it to what the bank has. If the book has it and the bank doesn't, then I list it on the bank. Usually that is outstanding checks. How do you like that abbreviation? Outstanding checks are checks that I have written, but because they haven't cleared the bank yet, the bank doesn't know about them. So I list them, and I total them, and I subtract them from the bank balance. Then I look at what the bank has that the book doesn't, and I add it to the book side. Things that the bank might have that's not in my general ledger account, because I don't know about it yet, is probably things like service charges, maybe bank charges for printing checks, that kind of thing. Maybe checks have bounced and the bank is returning them to me. I made deposits and they weren't good, so the bank calls those non-sufficient fund checks. And there could be errors. Errors can be added in or subtracted out. Depends on what kind of error I made. I could make it on either side. So I fix my errors as well. Now let's think about what we've done. We started with our ending balances of both. We've added things to the bank that the book had, but the bank didn't. And we've added things to the bank that the book had, but the bank didn't. Then we did the same process with subtracting. If the bank subtracted it, but we didn't, we listed it. And if we subtracted it, but the bank didn't, we subtracted it on the bank side. We put brackets on these. I don't think your accounting software has you do that, but I will. So once you've made a look at what each other's added and subtracted and listed the differences, you'll have adjusted bank balance, and that should now include everything. And you'll have an adjusted book balance, and that should include everything, and the two numbers should agree if you haven't missed anything. It's interesting to note that things that are listed on the bank side will almost always clear up with the passage of time. They're timing differences. The deposits will clear and the checks will clear. Things that are listed on the book side will more than likely require journal entries. Well, they'll always require journal entries. There are things that haven't been entered into your accounting records yet. That's in theory how you do a bank reconciliation. How about I give you a set of facts and then you use that to create your own bank reconciliation. Hold on and I'll draw up a problem for you. Wow, look at all those facts. We received a bank statement on October 31st. Some following information. The ending balance on the statement was $905. The bank showed an electronic transfer of funds of $410 was added to our account for rent revenue. Customer's check was returned for non-sufficient funds in the amount of $70, and there was a bank charge for $40 for printing new checks. After we compared the bank statement to our general ledger cash account, we determined that the outstanding checks in the amount of $450 hadn't been paid by the bank yet, and a deposit made on October 31st for $1,775 wasn't added in. But it posted normally on November 1st. It's not a problem, it's a cutoff issue. It's additionally determined that a check written correctly for $310 for salaries expense was mistakenly recorded in the cash account as $31. Whoops, mistake. Our cash account has a balance right now in it of $2,209. So, there's your facts. What I would like you to do is to put this on pause and create for me a bank reconciliation as of October 31st, reconciling the bank's records with the books. So put this on pause, and using that information, go ahead and make a bank reconciliation. Welcome back. How did you do? I got $2,230 on both sides. The only thing that might have been tricky was that error on the check. The correct thing to have done on that was to subtract $310. The incorrect thing was we only subtracted $31. So what we need to do to fix that is to subtract another $279. So between them, we will have reduced our checking account for the correct amount, $310. We have the bank's balance, a deposited transit, outstanding checks, leaving an adjusted bank balance of $2,230. The deposit will clear and the checks will clear. So those are self-correcting items. Our general ledger, however, has an account balance, we said at the end of the problem, of $2,209. There was an electronic funds transfer put in our account, the amount of $410 the bank had, but I didn't have it, so I added it in. I fixed the error on the check for salaries by reducing it for $279, as shown right here. There's a bank charge of $40 for printing checks and a bounced customer's check of $70. So the correct balance should be $2,230. Notice my checking account balance. My general ledger cash account's been transferred down here. It's currently at $2,209, and I need to get it to $2,230. Put me on pause and make the journal entries that will make this happen. I'll wait. The author has you make one journal entry at a time, so I'm going to do it that way, but I sure think it's the long way about it. Here's my journal entries. How do they compare to yours? I picked up the electronic funds transfer, and I'm going to post that to my checking account balance. I corrected the salary expense, and I'm going to post that to my cash balance. I picked up the bank charge of $40. I'm going to post that to my cash balance. Then the non-sufficient fund check. Notice I stuck that in accounts receivable. That customer still owes me money. Check the math. My cash account, it's now $2,230. It reconciles to my bank reconciliation. That then is preparing a bank reconciliation for a story problem, similar to what you'll need to do on the final. Hey, thanks for joining me for that. That was a ton of fun. I think we have one more thing we need to do, and it can be done really quick. I can do it in just a couple of minutes, so I think I'm going to keep going. It's the last thing in Chapter 8, and it is financial analysis. Ratio. So let's review a little bit and then look at the ratio we've added in this chapter. You'll recall from Chapter 1 that we were going to learn to do financial reporting for outsiders, that we would send to them an income statement, a balance sheet, statement of changes in owner's equity. Did that in the wrong order. The cash flow statement and notes. We would send this to outsiders, and that the outsiders could take this information and use it for decisions. And that we would learn along the way some ratios, so that we would learn what outsiders were doing with the financial statements that we prepare. And in this chapter, we learn the cash ratio. The formula for the cash ratio examines the relationship between cash and cash equivalents. We need to talk about that a little bit. What is a cash equivalent? Dividing that by total current liabilities. So what you end up with is, for every dollar in liability, how much cash do you have on hand? Cash is easy. It's just your checking account balance. But what's this cash equivalent? Cash equivalents are highly liquid investments that can be converted readily to cash easily within 90 days upon request without incurring any losses. So we go ahead and include those, although they're probably short-term investments. We include that in this number. So we take cash equivalents, divide it current liabilities. And what you end up with is, for every dollar current liabilities, how much cash do you have? Let's take an example for a business that has $15,200 in cash equivalents, and current liabilities of $305,000. You could say their cash ratio, when you do the math on that, is for every dollar in current liabilities, they have 4 cents in cash and cash equivalents. Ooh, that's a little tight. Further, let's say that's at 2012. Let's say in 2013, it had changed a little bit. They had $75,000 worth of cash and $280,000 worth of current liabilities. What is their cash ratio now? The answer is 27 cents. For every dollar in current liabilities, they have 27 cents in cash. Is this good? Is this bad? What's enough? What do we want this to be? And the answer is, it really depends on the business you're in. It's going to be situation specific. A bank, for instance, would like to have a lot more cash on hand than, say, a bookstore might need. So, how can you tell then? A ratio, like any ratio, is just a number point in time. Well, you could do a trend analysis where you look at the results of this ratio over the last several years, 2012, 2013, 2014, and what's the trend? Are they becoming more liquid or less? A really telling thing to do with this would be to compare it to the industry averages of the industry they're in, and then you could spot, how do we compare with our creditor or with our competitors? That would give you an inside feeling for what the numbers should be, so you could compare them and say we are as good as or we are not as good as through industry analysis, and you can say we're getting better or we're getting less liquid over time through the trend analysis. Well, that completes my review for Chapter 8. Only one to go. Yahoo! You're almost ready for your final. Thanks for joining me.